Hi there. In this video, we explain how HMRC applies the BPR trading versus investment test to buy-to-let portfolios in the UK. I'm from PTA.
Imagine waking up to find that your family's hard-built £10 million hybrid business is suddenly facing an unexpected 20% effective tax rate. Well, welcome to this explainer. Today we're unpacking a highly technical tax shift hitting UK business owners, brought to you by Pro Tax Accountants, or PTA. We are answering your absolute most common questions about buy-to-let portfolios and the BPR trading versus investment test coming up in the UK in 2026. And that brings us to that shocking 20% number. From April 2026, decades of hard work building up your portfolio could suddenly be vulnerable to a massive, completely unanticipated tax hit, literally right as you prepare to pass it on to the next generation. It's a terrifying prospect, isn't it? That's the stark reality a lot of UK entrepreneurs are just completely overlooking right now. But please don't panic. Pro Tax Accountant, or PTA, is your trusted UK guide here. We are helping businesses clearly understand and navigate these massive new inheritance tax rules, because with the right foresight, you can absolutely structure your affairs to weather these changes securely.
So, what's on the agenda? We're going to cover 1. What are the current rules and stats? 2. Who does it affect? 3. The trading versus investment test. 4. What compliance steps are required? 5. What mistakes should be avoided? And 6. A quick summary and next steps. Let's dive in. Section 1. What are the current rules and stats? And how exactly do we navigate this new 2026 landscape? Okay, so historically, business property relief, or BPR, was an absolute game changer for estate preservation. It allowed family businesses to pass intact down the generations with an unlimited 100% relief. But those days, they are officially gone. Starting in April 2026, qualifying BPR and agricultural property assets share a strict, hard cap of £2.5 million for that 100% relief. Anything over that £2.5 million effectively receives only 50% relief. And when you factor in the standard 40% inheritance tax rate, that excess is taxed at an effective rate of 20%. This is a monumental shift in wealth preservation, and it requires an immediate reevaluation of your estate planning.
Section 2. Who does it affect? Let's pinpoint exactly which businesses are impacted.
So, who is caught in the crosshairs of this legislation? Well, if your estate includes agricultural land, a trading business worth over £2.5 million, or trust property, you are directly affected. Furthermore, if you own a hybrid business with buy-to-let properties, you've got a real fight on your hands because you have to prove your active business offsets your passive income. And if you hold AIM-listed shares as part of your estate planning, pay close attention. These no longer get 100% relief at all. Your entire AIM portfolio is subject to that 50% relief rate right from day one.
But did you know? Because of a transferable spousal allowance, married couples and civil partners can potentially pass on up to £5 million in qualifying assets entirely free of inheritance tax. Any unused portion of that £2.5 million allowance can actually be passed over to a surviving spouse or civil partner, which essentially doubles your protective threshold if you plan things meticulously. Section 3. The trading versus investment test. This right here is the core conflict for property owners. How on earth does HMRC decide if your property portfolio is actually a business in the first place? Under Section 105(3) of the Inheritance Tax Act 1984, your business must be more trading than investing. That means over 50% of your activity has to be active trading, rather than wholly or mainly making or holding investments. And remember, guys, this is a strict all-or-nothing test. Hit 51% trading, you get the relief. Drop to 49%, you get absolutely nothing. It is literally a cliff edge for business owners who haven't audited their daily operations. And there's a really stark contrast in how HMRC views your property. To them, simply collecting rent on a standard buy-to-let or starting out basic repairs is presumed to be a purely passive investment. Honestly, it doesn't matter how busy it keeps you, it's an investment activity. On the flip side, running a high-service holiday complex, where you're providing on-site clubhouses, guided tours, daily cleaning, and meals, that provides a significant level of service that can elevate the whole thing to an active trade in the eyes of the taxman. Now, what about hybrid businesses? Say a traditional farm that also happens to rent out converted cottages to long-term tenants. Well, landmark judicial precedents like the George and Farmer cases are your best defense here. They prove that HMRC has to evaluate the overall character of the enterprise as a single, unified entity. If your active trading predominates, the investment side essentially gets pulled right under that protective BPR umbrella. You don't have to separate them, as long as the active trade is clearly the dominant force. But how do you prove it predominates? To pass the test, HMRC weighs 5 distinct pillars in the round, derived from that very pharma case, just to decide if your buy-to-lets are basically a side hustle to a main trading business. They are going to look incredibly closely at your turnover, your profit margins, the capital employed, where your employee time is actually spent, and the overall context of your operation. You need to win on the majority of these pillars to survive a rigorous tax audit. Holistic record keeping is absolutely essential here.
Section 4. What compliance steps are required? Let's get into some highly actionable advice.
Knowing the rules is one thing, but establishing the exact compliance steps HMRC requires to prove your trading status is another beast entirely. First, you must have up-to-date professional RICS valuations. HMRC is not going to accept back-of-the-napkin maths when millions of pounds in relief are on the line. Second, you need crystal clear profit and loss accounts that completely divide your rental income from your active trading income. And third, you absolutely must maintain strict, verifiable records of employee time. Which brings me to a professional tip. Always keep detailed timesheets for your staff. Documenting exactly how many hours your employees spend on active trading duties versus passive property management is very often the deciding factor for HMRC during an audit. If you can definitively prove that, say, 60% of staff time goes toward the active trade, you've just built an incredibly powerful shield against any challenge to your BPR claim. Section 5. What mistakes should be avoided? Let's examine the common pitfalls. To protect your legacy, you have to be aware of the costly mistakes that entrepreneurs commonly overlook. A massive trap is holding what HMRC calls accepted assets. Simply put, if you have huge amounts of surplus cash just sitting in your company account that isn't actively required for future trade, or if you hold personal use assets like a family holiday home within the business structure, HMRC will aggressively exclude the value of those specific assets from your relief calculation. Furthermore, please do not assume that just because you operate through a limited company, you automatically qualify. Corporate structure absolutely does not dictate trading status. You also need to avoid excess cash buildups. And whatever you do, do not have binding contracts for sale upon death, like certain cross-option shareholder agreements. HMRC views that as essentially holding cash, which instantly disqualifies you from BPR. Finally, be super careful with lifetime gifts. If you gift business property and die within 7 years, the recipient generally still needs to own it, and it must still qualify as a business asset for the relief to hold. Section 6. Summary and next steps. Let's look at securing your future. To summarize the whole shebang, the £2.5 million allowance cap is now law as of April 2026, bringing with it a 50% relief rate on any excess value. The wholly or mainly trading versus investment test is stricter and more vital than ever to navigate. And of course, a quick disclaimer, this overview is strictly for educational purposes to help you understand the landscape. It is not formal financial or tax advice. Don't leave your family's business legacy to chance. Contact Pro Tax Accountant today for tailored professional advice to ensure your estate is structured properly before these rules take full effect. You can reach the team by phone at 07985 689 912, drop an email to info@protaxaccountant.co.uk, or visit www.protaxaccountant.co.uk. And hey, be sure to subscribe to the PTA YouTube channel for more deep dives and accounting insights. I'm going to leave you with this final, crucial thought. If HMRC knocked on your door and looked at your business accounts tomorrow, applying the stringent 5 pillars of the pharma case, are you absolutely certain you'd pass the trading test? Or is your portfolio a ticking tax time bomb just waiting to derail your family's financial legacy? Make sure you get the right advice today. Thanks for joining me on this explainer.